Hello, and welcome to Payments Unfiltered, powered by Primer. I'm your host, Theo Spyrides, Head of Product at Primer. And in this episode, I am joined from New York by Will Artingstall, Global Head of Digital Asset Payments and E-commerce Services at Citi. Will has spent 15 years at Citi, moving across roles and geographies, and for the last 6 years has spent his time focusing on global payments at the bank. In this conversation, we get into why more large merchants are choosing to connect directly with acquirers like Citi, what crypto and stablecoins actually change and what they don't about existing payment rails, and how Citi is thinking about co-creation with fintechs and merchants rather than simply selling to them. Let's dive into the conversation. Will, thanks so much for joining us today. Maybe as a starting point, could you give us a quick introduction into kind of who you are and what your current role is?
Yeah, Theo, so thank you very much for having me on. It's great to be part of the conversation. I am Will Artingstall, have been at Citi for a long time. I'm currently part of our global payments product organization, and I lead our digital asset payments and e-commerce services globally from that business.
Amazing. And maybe as a starting point, how do you at Citi work with merchants today?
Yeah, we work with them across several different fronts. We sort of from a couple of different maybe perspectives I'll share. The merchants we would tend to work with could be anybody that's maybe looking at doing anything from like basic acquiring to us. So they may be using things like our Spring by Citi platform to do just general online acceptance. The second way we may potentially work with merchants is we work with several fintechs around the world today, and a lot of them do both acceptance and settlement for those players. So we could be, both a direct player and a direct participant with them, as well as somebody that's serving another participant in the ecosystem that then pays them or provides other services to them. So we see merchants from both perspectives.
Amazing. And I think the first the way that you kind of work with merchants, where they kind of work with you directly as an acquirer, I think is something that I'm super interested in to kind of dive in more with you, because this is certainly something I'm seeing coming up more and more in conversations with the merchants that I get to speak with. So maybe as a very basic starting point, why would a merchant kind of come directly to Citi for an acquiring relationship versus going via a PSP?
Yeah, it's a good question. I mean, I think when you think about a basic, and this is, I think, specifically on the acceptance side of the flow, if you think about the nature of that specific process, you have multiple participants that tend to form part of a single payment lifecycle, right? So you could have a gateway, you could have a processor, you could have an acquiring bank, and then you could also have a final bank account. So having or going direct to the acquiring bank can make a lot of sense for a lot of different reasons. And in particular, in areas like e-commerce, where basis points matter, where just that like last 10 to 15 to 20 basis points of additional acceptance can make a huge difference when your GMVs are very, very large and your margins are small. These things really, really matter. And the main theme there is really around bypassing several of these intermediaries. So when we tend to see a merchant that wants to come direct to us, really what they're looking for is a couple of different things in reducing the number of players that are involved in that gateway processor acquiring bank relationship. The one could be a cost efficiency play. So obviously having an aggregator who's doing all of that activity themselves may have the ability to reduce the cost of doing that. The second is faster settlement. So you can also potentially eke out some faster settlement benefits, again, because you're not moving between multiple third parties during that process. Enhanced data and reporting is usually quite a common benefit as well. Again, when you're coming directly to the acquiring bank, you're having sort of the benefit of both the data at a gateway as well as the treasury reconciliation in the bank account held by a single participant. And the advantage of that is reconciliation can be enhanced as a result of those data points being through one player. We also tend to see, a couple of additional questions around things like optimization of conversion rates. So that can come from a couple of different avenues. If you think about a large scale player, somebody like Citi, you tend to also be an issuing bank. And so, you can look at really dialing in some of the risk metrics around the acquiring of Citi cards in particular, as an example. That gives you a huge benefit when you're thinking about, again, those couple basis points making a difference every single time you look at acquiring. And then the other benefit I would sort of mention is really around higher resilience. Again, if you think about reducing the number of players or the number of hops you're having to move between third parties, that makes quite a big difference. And I sort of, think back to a very sophisticated client that we spoke to a couple of years ago, and we were really, really interested by some of the insights that they gave us. They were, and I forget the day that they were exactly talking to us on, but they were looking at our acquiring bins and noticing a slowdown in performance on one of the bins. And they were asking us about a very specific time and a very specific day of the week. And what we realized when we went back and did a look internally was that was one of the bins we used for testing. It was quite interesting to see the level of sophistication that some of these acquirers are reaching, or some of these merchants are reaching, where they're able to actually really, see that resilience at that level, and again gives them yet one more lever to be able to really optimize some of their acceptance rates. So we see sort of several benefits like that in them actually going down the pathway, and why they'd be interested in going direct.
Got it. So I think you touched on a lot of interesting things there. Like, first thing is like cost savings, especially when we're talking around like mid-market to enterprise. Like, basis points can make a big difference. Reducing intermediaries can sometimes increase like reliability. Better kind of enhanced data, and I think I see a lot of value there. I think the one that also maybe stood out to me the most, and I've heard from a few other folks as well recently, is around this kind of when you're on both sides of the transaction, when you're both as the acquirer and the issuer. So you talked around like the risk rules there. So if I understand correctly, because you're on both sides of the transaction, you're able to make sure that the kind of authorization will probably have better performance, because you'll have much more data than anyone else kind of acquiring that payment. Is that correct?
Yeah, so there's two ways you would tend to think about this. The one which is maybe the more innovative and less frequently used is looking at potentially redirecting traffic away from the card. Like, maybe there's an opportunity to do things like an on-us transaction, but actually the real magic is even just in really simple things. So as an example, you may look at the decline reasons when you're looking at the actual issuance of the card, and find that one of the main decline reasons is happening because the transactions are, $5 to $6 over the credit limit of the card. You may decide as the issuing bank that you're okay to allow those transactions to go at risk because it's a small addition onto the overall credit line of the card. But by doing those things end to end, you can really dial in those little conversion rates. Again, because to your point, you've got access to the data on both sides of the transaction. So it's allowing things like that to happen that smoothen out that acceptance process. And it's really just a little bit of risk tolerance that you're able to take and make, optimizing that acceptance flow because you see both sides of the transaction.
Yeah, so I think if I play that back to you to make sure I've understood correctly, you essentially have like access to unique levers to enhance performance because of your access to all the data and because of the tolerances and decisions that you get to make because you see the entire transaction.
Yeah, that's right. Yeah, I mean, essentially, if you think about it in that type of scenario where we're thinking about being on both the issuance side and on being on the acceptance side, in that case, the merchant is my client and the card holder who holds the card is my client. I know both people.
Mm-hmm. Amazing. Awesome. Thanks so much for sharing that. So maybe switching gears slightly, we've in fintech and payments, there's always lots of trends. It's an amazing industry for innovation. And I think one of the ones that stands out at the moment is a lot around stablecoins or cryptocurrencies. Citi have been in the news as well recently with Coinbase as well. So I'd love to kind of get your take on stablecoins. Maybe as a starting point, you could explain to the audience, like, what is it? And how do you think this new technology could impact kind of traditional payment rails?
Yeah, happy to do that, Theo. So we always like to paint the picture about what it is by talking about, 5 different forms of money. So when you think about money and especially money in sort of the future state, there's various different forms of money, right? And so one form of money is central bank money, which is accessed by commercial banks. We use that to settle between each other, and it really rests and sits on the central bank's balance sheet. The second form of money is commercial bank money. And commercial bank money is the money that a bank like Citi would hold as a liability on its balance sheet for its customers, right? So that's the second sort of form of money. During the fintech revolution, we saw the emergence of a third type of money, which we classify as e-money or electronic money. That's usually money that's sitting on a fintech's platform, but it's backed by fiat that's sitting in a bank account somewhere. So that's an example of what I would call like traditional forms of money that are really making up the first three versions of the truth. Then what we saw sort of coming out of the 2008 white paper was public cryptocurrency. And public cryptocurrency was really, a cryptographically sealed token that used cryptography and scarcity as a methodology for designing some form of value for the actual underlying currency. There was no real sort of like major peg to any core currency. It was a real different way of thinking about ledger movements and the likes. But it didn't really have any representation in the traditional fiat world. So that was kind of, I think, the starting points of what we saw coming out of that, the Bitcoin white paper back in 2008. If you fast forward to what then started to happen, there was a huge amount of volatility in public cryptocurrency, huge swings in terms of the valuation of those currencies. So a lot of question marks started to rise around whether they were useful as things like payment tools or as stores of money. And so what emerged was a method of trying to effectively create a stable coin, which created the stability that you have within fiat, and usually did that by pegging the actual token itself to dollars or some form of hard currency. The methods varied quite a lot in the beginning. So you saw everything from, logarithmic methods to try and figure out what a peg could be, right through to multi-asset backed stablecoins. So there could be a variety of different assets that back the actual underlying stablecoin, through to actual one-to-one backed fiat type stablecoin, where you have $1 backed in a bank account backing or in reserve that's backing the actual token that's sitting on chain. That's been kind of a real core method that's come out of late, and that's been the one I think that a lot of the interest has started to bubble up around, where essentially it's a one-to-one backed, one-to-one pegged instrument that is really a token on a blockchain. So that's kind of the fifth form of money that we see. One thing I would highlight when you think about all five of those is all five of them are actually going through some form of tokenization and digitization in the world today, right? When you hear about central banks talking about CBDC, that's really central banks thinking about digitizing the central bank money. When you hear commercial banks talking about tokenized deposits, that's really the tokenization of commercial bank money. So all of these things are going through methods of tokenization today. Now, to answer the first part of your question around, where are we seeing that sort of interest today? Are we seeing interest today? What I would say is this, that there is an increase in corporate interest in tokenization broadly. They're very interested in the topic more broadly, and it's really driven by a lot of their desire to innovate, potentially reach new customer segments, and then any potential efficiencies that may come out of driving transactions through tokenized forms of money. And what I would say is we're seeing most of the clients within our segment. So where I come from within the bank is the large institutional side of the bank. We're seeing most of those clients really being in an exploratory phase and looking at whether there is a demand that they need to cater for as a result of that. And in fact, Jane, during our recent earnings call, specifically mentioned, that we're starting to see demand and adoption that's increasing. But one of the main gating factors really is our clients' own treasury departments. And one of the biggest challenges they have is not being always on 24/7 at the moment, right? The other challenge is obviously from a tax and accounting perspective, a lot of them are not fully ready to hold it on their balance sheet. And so they're really thinking about how they could explore this space and how they could think about this a little bit more broadly. And what she sort of like anecdotally mentioned, which I think is an important one, is she levered on again the interoperability here, and really that we view stablecoin as another option in the overall digital asset toolkit, right? It's going to become a form of payment in the broader payment landscape. That's really the way I think we kind of look at it. The second thing I think I would sort of say is we are at Citi inherently client led, right? I think we want to be where our clients are. And if this develops as a major need for our clients, that is then obviously something that we become interested in and want to make sure we're looking at from a product and capability standpoint. And you would have seen a lot of work coming out of us. You'd mentioned one of them, but I want to highlight a couple of additional things I think we put out of late. And the one is really the Citi GPS report that came out in 2025, where we'd argued that 2025 was the chat GPT moment for the institutional adoption of blockchain, right? That was the statement that the team had put out there, which was quite a nice provocative statement to make. And I think that the last 6 months have really confirmed this, that digitally native companies in particular are the ones really most interested in leading some of the real world charge around this. And so we really see an ecosystem where all 5 of those forms of money that I'd mentioned, which are being tokenized, and fiat itself continuing to flourish and coexist. It's the same as when the fintech revolution came about. Cash still exists, checks still exist. A lot of these forms of payment have continued. Cards have still continued to exist. And so we think that that's likely to pervade at least for some time. And that's why I think we keep saying that interoperability is such an important thing here, and really is what our clients come to us for. If you think about Citi, we're a global payments organization who provides a plethora of payment capabilities to our clients. They don't come to us typically for one form of payment. They come to us for multiple forms of payment. And that's why we view interoperability as such a key step within this, and actually have taken several steps in that space for alternative payment methods already, doing things like connecting to wallets, connecting to cards for payouts already. And an example of that in the digital asset space, as you mentioned, was the collaboration we announced with Coinbase, where we're looking at exploring digital asset payment capabilities for institutional clients, and are focused on fiat pay-ins and payouts in particular, as well as payments orchestration. That was kind of what we'd mentioned within that space. So we're very excited about that opportunity and what that could potentially yield. The second thing we'd also mentioned was the connectivity of our tokenized deposit platform, Citi Token Services, and our 24/7 clearing platform. Both of those we see as pretty exciting opportunities to really build some of that interoperability that we're talking about.
Amazing. I'd love to dive into quite a few areas there. So let's go one by one. So you mentioned the kind of what you're hearing from merchants is around kind of mainly from the treasury team, and like how can I leverage this kind of new form of currency in order to kind of optimize what I'm doing as a treasury function. Maybe a basic question, like what are those optimizations? Is it cost? Is it speed? Is it both? Do you have a sense of that?
Yeah, so Theo, this is a great question. And actually, we a couple of years ago realized that if you want to ask the smartest people in the room, you ask your clients. So we ran a survey about 2 years ago now, and we repeated it last year, where we specifically asked our clients, and this was kind of like abstracted away from even just trying to solve for, whether it was tokens or whether it was fiat or whether it was an alternative payment method. It was just trying to solve for what do they see as the biggest competitive levers in what is an increasingly multifaceted competitive landscape. And the response we got from them was like very, very clear. There were 3 things that were mission critical to clients, right? The first was cost efficiency. The second was speed. And the third was transparency. They viewed all 3 of those things as pretty important levers for when they think about the actual transaction process. So those were kind of the 3 pieces of feedback that we got from our clients as they were thinking through what they're trying to solve for.
And what is like the gain for, is that gain like applicable to all markets, or maybe more to like certain markets such as emerging markets, or do you see it kind of being more of a global application?
Yeah, a great question. I mean, so Theo, I think what's quite interesting about the way you framed that question is, whether we see it as like a global thing or is it a specific thing. If you think about this, like there have been markets like Brazil which have led with payment platforms like Pix, which are incredibly fast, right? We're talking milliseconds and at the worst case, seconds to settle a transaction. They've seen widespread adoption in a market like that. I think the last stats I heard, and I could be corrected on this one, was north of a third of all transactions in Brazil are now on that platform. So really, really wide scale adoption. So that's the first thing I would say is, in a market like that, it's tough to beat that scheme because it's really, really fast already. The second thing I would say is, if you think about the work that even Swift has done in trying to speed up some of the global tracking platform that they have and actually speeding up the transactions that they have, the vast majority of their transactions are settling sub half an hour, sub an hour in most cases, with the vast majority settling in the same day. So when you think about a B2B application where a client knows 90 days ahead of time when the payment is due, they know who it's due to, how much it's for, and are able to prepare and plan for that. I think that's one area where, when you look at how much payments have moved on, even in the traditional space today, there's some sort of real question marks around what is the incremental benefit that we get by going down some of these pathways. So that's kind of the first statement I'll make. The second statement I'll make is around what creates friction in the payment process, right? And this is a really important question for emerging markets in particular. And I come from South Africa, which is a market that's got a really well-written, very clear exchange control sort of regime. But if you look at the payment process itself, it's not the payment, the FX, and the actual transaction that is the thing that makes a payment take 3 days out of a market like South Africa. It's the preparation for the exchange control, because the document you require an invoice, you require regulatory-based reporting. You've got to check the invoice. You've got to make sure it balances to the payment amount. So a lot of those processes, which are quite people-centric today, and that's kind of by design, a lot of those processes are the things that slow down the payment. The actual technology itself is pretty quick. If you execute that payment within a cutoff window, you're going to make that payment happen the same day. So that's kind of the backdrop I would start with. And then I would talk a little bit about our own experience here. And if I look at Citi Token Services, which has been a very successful platform for us today, it's a 24/7, 365 near real-time payment settlement platform. Really speaking, what we've seen with a solution like that is clients have been using it to balance their treasury positions 24/7, 365. So what's nice about that solution is, in a world where cutoff times have been something that you've always had, that solution is 24/7. So if it's a Friday evening and you need to rebalance your treasury positions between, let's say, the UK and the US, you can do that with a platform like Citi Token Services. So some of the real world benefits have really been around practically solving actual B2B applications like that, where you need to make a payment that's after hours, and a solution like that actually solves for it. I think what's going to be interesting is looking at what the future use cases are going to be. So when we start to get into things like programmable payments on chain, that's a very fascinating space to me in particular, where that is not catered for today in the traditional fiat world, where I can program something down to the nth degree between a number of different participants. And I can see a world where things like conditional payments could be really interesting in trade use cases, where historically you've maybe used an instrument like a letter of credit or a guarantee. Something like a conditional payment could potentially look at replacing solutions like that in a bit more of a simplified way.
And so that 24/7 clearing capability, is that built leveraging stablecoins? Or is that leveraging different types of technology, maybe more focus on like blockchain itself and not using the stablecoins that might sit on top of that blockchain platform?
Yeah, so Theo, great question. So Citi Token Services is essentially a tokenized deposit, right? So it's a token representation of a deposit that's held in a bank account. So the advantage of a solution like that is you end up with all of the benefits that you get from moving tokens around on a blockchain. But you also get the benefit of the fact that it is really just a deposit. So it's got very clear regulatory clarity. It is treated as cash. It's easy to account for and easy to provide a balance for. And so, when we've looked at that in our minds at least has been a pretty a pretty powerful solution, and why a lot of the corporates that we work with today have really seen it as an easy tool to adopt. Today, since we did the commercial launch of this platform in 2024, we're already starting to see billions of dollars worth of transactions flow through that platform. So you can see, just by making it an easier concept to understand, providing the same token benefits, the adoption has taken place. And again, I think some of those real world applications, as I've mentioned, around being able to move money around 24/7 has been pretty useful as treasuries have thought about trying to settle.
Mm-hmm. And we've spent quite a bit of time talking about like the B2B side. Do you see like a growing interest or growing appetite on the customer side for like leveraging stable coins more on like maybe the payment or acceptance side, all the way also down to maybe the payout that they might receive from a business?
So Theo, I think we do. I mean, I think as I'd sort of upfront said, I think a lot of these are still in fairly exploratory stages. So, one of the things we saw this year, which I thought explains this in probably the best way, was BCG produced a report on, it was called 5 killer tests for stablecoin, I think was the name of the paper. And in that, they spoke about the sort of size of some of the transactional flow. And they, I think, were one of the first I've seen to actually try and size the payment flow in stablecoin. And they classified it in 3 different methods, right? So the first was P2P payments, and they sized that around $500 billion. Then they sized C2B, that was about $400 billion. And then they sized B2B at about 400 billion. Now, if you look at that, like, they all look like it's fairly equally dispersed, but the reality is P2P is the smallest subsegment of that. And so, $500 billion of the P2P segment is pretty sizable market share. In the C2B space, it's much smaller. It's going to be sort of in the 1 to 2-ish% market share range, based on sort of, even if we just look at the flows within e-commerce. And then in the B2B space, it's quite small, right? It's a real fraction at that point. But what's quite interesting when you think about that sort of market read is obviously what is spurring a little bit of the interest here from e-commerce and some of the fintech players is, if there is increased growth in P2P, what that means is increasing consumers have got access to stablecoin, which may mean you need to have that as a form of payment in order to accept flow from a segment of your client base. But again, if I think about that, and we mentioned this a little earlier, like, that's why I think we view this as something that will form part of the broader payments ecosystem, because I always like the philosophical test of, if you asked 50 people in a room what their favorite form of payment was, you probably get 60 answers, which is just evidence to how, as people, we love choice. We love this illusion that we can choose what we do and how we pay and how we do that. And so that's why I think where the real question is coming in is, are we seeing a point where the number of people that are, let's say, maybe driving peer-to-peer payments through a solution like this, and therefore have access to stable coins, is increasing to a point where you need to include it as a method of payment?
Got it. So stablecoin, super exciting technology being explored in many different ways, both on the B2B and the B2C side. If I'm a merchant listening to this and I have no idea about stablecoins, but I hear this and I'm excited and I want to kind of explore as well, like, what advice would you give them around like how they should start their journey kind of thinking about stablecoin and how to kind of embed it in their business?
Yeah, wow. I mean, so first thing I would say, Theo, is this has been, I mean, following some of the regulatory shifts, towards the tail of last year, and some of the progress made this year, I would sort of put out there two pieces of advice for folk. The first is, read. There is so much intel out there. I have a personal statement where I kind of am saying, I'm hoping we don't end up with like announcement fatigue with the amount of things being announced. We miss something really big and something really important because of just how much is being pushed out there today. But the second thing I would say is, watch the regulators in this space. And the reason I say watch the regulators in this space is, we are seeing, the ones that have gained the most amount of notoriety have obviously been the very large economies. So Genius has gained a huge amount of sound and had a lot of airtime this year. Meek has had the same. But I can tell you silently, all of the emerging markets are starting to produce frameworks and regulatory guidance around stablecoin issuers, and stablecoin and crypto activity. So highly recommend that any merchant who's thinking about this space really thinks about it from a couple of perspectives, both the what it is, the how it operates, the benefits the technology can bring, but also is acutely aware of how the regulatory shifts are starting to take shape.
Got it. So if I'm a merchant, get reading, get talking to folks, make sure I don't miss any big announcements. And I hear you on announcement fatigue. I don't think that's exclusive to stablecoin. My LinkedIn is full of announcements every single day of something. I hear that for sure. You said something very interesting earlier, which maybe I'd love to kind of pick your brain on, which is this notion of co-creation. So how, you're a leader in the payments and banking space, right? So how do you make sure what you're building has the maximum impact and positive outcomes on your customers? And I assume co-creation is one of your core methodologies there. Should you maybe talk to that?
So I like this idea and this concept of co-creation. It was spearheaded by our global head of payments, Debo Sen, and she's spoken quite a lot externally about the method as a tool for us to be able to push deeper and more impactful client engagement. If you think back a little bit to product development, and I'm talking 10 to 15 years ago now, we built a lot in a little bit of like a vacuum, and I think the reason we did that was the payments use cases were a little bit more simple, right? We were talking about going to a client, we were pitching them a payment product that they were going to use for something very simple: payroll, a vendor payment. The complexity around the actual payment and the use case they were using to make that payment was fairly small, right? It wasn't an overly complex thing. But if you look at what the fintech evolution did and what we've started to see with e-commerce and the embedment of payment within process today, there's been a subtle but fundamental shift. And that is that today, many clients are procuring payments in order to embed in their own processes, right? And what that's resulted in is you've started to really see payments become part of the product. And the one I always think about is, if you're online and you're buying something and you decide to check out, many platforms today have like a single click checkout. I don't even feel the payment anymore, right? It's like I press a button and the payment executes, and a day or two later, the product arrives on my doorstep. But the same is true in terms of many other players in like the gig economy place. If you're a ride-hailing business, you've got them developing things like on-demand driver payouts. It's the click of a button to a driver, but it's an API call and an instant payment that's settling to the driver on the back end. And I think what's kind of interesting when you think about that is the subtle change here is I'm no longer selling a proprietary solution. The solution I'm selling is really a payments product that a client is using to sell to their own client or to their own ecosystem participant. And that's subtle, but it's a fairly big difference that brings a lot of complexity and nuance to any payment flow. Now, what that means is that you've got to spend a lot more time working through with your clients on what they are going to use the payment for and how they're going to use the payment. And I always think about this. You think about payments and you think about this awesome thing you've developed around a platform and you think, wow, that's so amazing. It's so sexy. But the reality is it's not. Like, the stuff that's actually the payment guys geek out about is trying to get data into the payment message that's passed back to the platform so that someone can be self-served because there's information coming out of the payment instruction or from the payment itself, the payment message itself, that can be used by a service team or shown on a screen or on an app somewhere that allows you to do that. Now, the problem is, if you think about that as a product professional, I can't design that without knowing what the client needs to see or what experience the client is trying to drive. And that is why this co-creation methodology is such an intuitive thing, but it's a really important step for us. And the outcomes that really matter here is, number one, you have a client who is commercially ready to use the product you've developed because you've developed it with them. And then the second, usually you have a product that can be leveraged with other clients because most clients in that space are trying to define similar types of use cases. And it's been incredibly effective for us, specifically in the e-commerce and fintech segments where that complexity really, that I described, that complexity really lives. And I think what we've done is really, you have to start that methodology by understanding clients' real world problems. You have to pick a problem that you believe exists across multiple clients or multiple segments. So, if you're a fintech today who, let's say, for example, has challenges or questions around, let's say, for example, fin crime requests for information, right? They're making payments themselves. There's lots of things that may potentially require a query or an understanding or a secondary round of information. If you design, for example, an automated process around APIs for that, you don't want to do it in a vacuum. You want to understand what information you're going to be requesting from the client and whether that information can be automated. And so designing a solution like that hand in glove with a client is really something that allows you to sort of build the API in a way that's actually going to be consumable by the client. And so that's really what we mean when we talk about co-creation. It could be something as small as that, but it could also be something far more complex, like a marketplace embedding financial services, or looking at licensing or cross-border payments, or really truly scaled use cases around 24/7 instant payments. So in my mind, at least, we've seen a huge amount of upside and a huge amount of benefit in co-creating with our clients just because of the backdrop of that complexity that's come into their life cycle.
Yeah, this resonates so much with me. I think being in a startup as well, like that's how you get started. You talk to your kind of persona, you understand the friction, you understand the pain points, and to your point, I don't think it resonates so much more in a B2B space, right? When you're providing a service that's probably being passed on to a consumer or something like that. If I'm someone listening to this and I'm inspired around like co-creation and I want to kind of introduce this into my business, what are maybe some of the pitfalls that I should be careful of when approaching this and making sure I do this in a way that delivers maximum business value for my business, but I also maybe avoid the things that could maybe trip me up down the line?
Yeah, and Theo, from the perspective of the client or from the perspective of the bank, just so I clarify.
Yeah. So from the perspective of the business building the product,
yeah,
what are maybe some of the pitfalls with co-creation that I should just be aware of? Maybe I could overfit my product, or what is it that I should be very conscious of to make sure that I use this as maximum value for my business and make sure I stay away from the things that could maybe
100%. Yeah, I love it. Okay, so that's I would say that, look, I think one of the pitfalls here is often when you go in with this methodology to a client and you sort of suggest an idea of, hey, throw your problems at us. If you throw everything, you end up with too much to kind of look at and bite off. It should be something that, at least from a business perspective, warrants being solved, and with some degree of certainty is at least going to get prioritized within the business that you're in, right? So you've got to prioritize. You've got to pick 3, maybe 4 problems. So really limit the number of things you're trying to solve for. The second pitfall I would raise, which I think is really important, is, at least in our experience with co-creation, making sure you have the right people around the table is very important as well. And usually that's a combination of 3 archetypes of people. It's the business people who understand the business problem, the clients who they're trying to solve and sell to. The second is product people who can help think through how the solution itself is going to work. And the third is the technology people, the people that are actually going to, key in the code and figure out what infrastructure is going to make the solution work, because they help you to really think about the constraints and the art of the possible in a bit more of a dynamic way. And then the only other thing I would really say is make sure that you're open to allowing the problem to be solved in a way that's not so bespoke. Typically with co-creation, you really want a problem that is kind of not just unique to you. It's something that is solvable across the industry. It solves multiple people's problems. And the reason you want to do that is usually the fintechs, the banks, or the partners you're going to work with on co-creation are also thinking about their own resources. And as a result, if your problem is overly bespoke or overly unique to your business, unless the business case stands up on its own just for your business, they're not going to prioritize it on their side as well. So those are probably the top 3 pitfalls I'd think about.
That's amazing advice. Thanks so much for sharing. And yeah, I'd echo all of those. I think the risk of overfitting is something that I see a lot in startups who, go talk to a customer, hear the problems, want to win the business, but then actually don't abstract the problem and think about like its broader application. So I think that's amazing feedback. Well, I think that's all we have time for today. So I just want to say thank you so much for your time, for sharing your amazing insights. And thanks for joining us on Payments Unfiltered.
Thank you, Theo.
It was great to have Will on the podcast with us today. I really enjoyed his insights around the benefits of merchants connecting directly to acquirers, the inside line into like all the amazing things going on in the stablecoin, and obviously how Citi approach co-creation with merchants and the customers that they work with. If you have enjoyed this conversation, there are plenty more with people building, operating, and reimagining payments across the ecosystem. You can find Payments Unfiltered on YouTube or wherever you get your podcasts, and I'll see you next time.